Welcome to MindMirror Audiobook. In today's video, we'll dive into two dramatic stories that reflect the rise and fall of the financial world through unforgettable moments. From the dot-com bubble crisis, where Pets.com made a splash but ultimately crumbled, to John Paulson's billion-dollar bet during the subprime mortgage crisis, these stories are not just about risk-taking but also serve as warnings on how we handle opportunities and dangers in the financial world. Let's immerse ourselves in the pivotal moments that changed entire markets. Let's start with the first story. Back in the late 1990s, the world was buzzing with the promise of a new frontier, technology. The internet was a revolutionary force, and the dot-com bubble was at its peak. Everyone wanted a piece of the action. Enter Pets.com, a company that became synonymous with both the excitement and eventual demise of the dot-com era. Founded in 1998, Pets.com quickly rose to fame with its bold idea: an online pet supply store. It was an idea that, at the time, seemed like the next big thing. The company gained massive attention thanks to its clever marketing, including the beloved sock puppet dog mascot. The ads were everywhere, from TV commercials to Super Bowl slots, and before long, Pets.com became a household name. But behind the flashy campaigns and the growing hype, something wasn't quite right. In 2000, Pets.com went public with an initial public offering, IPO, raising millions from eager investors. The stock soared, driven by the excitement surrounding the next big thing in online retail. Investors were hungry for the next Amazon, and Pets.com seemed like a surefire winner. But beneath the surface, the company was struggling. Despite the massive funding and strong brand recognition, Pets.com had a fatal flaw in its business model. The company was selling pet products at low prices, but the shipping costs were astronomical. Add to that low profit margins, and the company was losing money on every sale. Pets.com spent more on advertising than it made from product sales. The business was burning cash at an alarming rate. Yet, the management team, led by an overly confident leadership, continued to double down on the belief that more marketing and expansion were the answers. They pushed forward, convinced that if they built it, customers would come. But they failed to ask the crucial question: how do we make a profit? The overconfidence of the leadership and their belief in the company's future growth led to irrational decisions. They were so focused on visibility and growth that they neglected to address the company's structural issues. Pets.com expanded rapidly, but it never bothered to optimize its operations or supply chain. Instead of reducing costs or improving its logistics, the company poured more money into flashy marketing campaigns, hoping that the world would buy into the idea without considering the hard work it would take to make the business sustainable. Then came the inevitable crash. The dot-com bubble was already showing signs of strain, and Pets.com was one of the many casualties. Despite raising millions, the company's stock price began to plummet. Just 2 years after its IPO, the company filed for bankruptcy in 2000. What had once been a stock market darling, filled with promise and excitement, had become a cautionary tale. Investors lost everything, and Pets.com went from a booming business to a symbol of the dot-com bubble's explosive end. The failure of Pets.com highlights several key lessons that anyone in business or investing can learn from. First and foremost, focus on the fundamentals. Pets.com was driven by hype and speculation, not solid business practices. Investors were captivated by the idea of online retail but overlooked the financial health of the company. In hindsight, it's clear that no amount of marketing or hype can compensate for a business model that simply doesn't work. Speculation may generate initial interest, but it can never sustain a company in the long run. Another critical lesson is sustainability over growth. Pets.com's biggest mistake was prioritizing growth at all costs. The company expanded rapidly without considering how to make its operations profitable. The drive for growth led to mounting losses that it could never recover from. In business, growth should be a balance between scaling and creating sustainable, profitable operations. Finally, don't fall for market euphoria. Pets.com's rise was fueled by the excitement and speculation of the internet boom. But when reality set in, the bubble burst. In the rush to invest in the next big thing, many investors ignored the risks. Pets.com's failure reminds us that market euphoria can cloud our judgment. Always take a step back, evaluate the risks, and understand the fundamentals before making an investment. So, what can we take away from the story of Pets.com? It's a stark reminder that, in the world of business and investing, it's not about chasing the hype or falling for the next shiny object. Profitability is key. A business must create real value to sustain itself. And just because something seems exciting doesn't mean it's built to last. If a company isn't sustainable in the long run, no amount of hype will save it. Pets.com might be gone, but the lessons it left behind are invaluable. Focus on the fundamentals, balance growth with sustainability, and never get swept up in market euphoria. Only then will a business truly thrive, not just survive. The story of Pets.com serves as a valuable reminder not to let ambition cloud our ability to assess reality. But the story of risk-taking in the financial world doesn't end here. In another era, one investor was able to foresee an impending collapse, not in the tech industry, but in the real estate market. This is the story of John Paulson and his billion-dollar bet during the subprime mortgage crisis. Let's explore how he saw the danger before it all unfolded. Let's dive into one of the most remarkable financial stories of the 21st century. In the mid-2000s, while the world was living in a false sense of financial security, one man, John Paulson, saw the storm brewing on the horizon. As home prices soared and banks handed out subprime mortgages, loans given to borrowers with poor credit, Paulson, a hedge fund manager at Paulson and Company, was one of the few investors who understood that this wasn't just a boom, it was a bubble, ready to burst. During this time, the financial world was enamored with the housing market. Almost everyone believed that home prices would continue to rise, and mortgage-backed securities, MBS, financial products bundled from home loans, were flying off the shelves. Investment banks were more than eager to create new securities, pushing them into the market with the belief that the rise in home values would continue indefinitely. But while everyone was caught in the frenzy, Paulson stood out for a reason. He didn't see a booming market. He saw a disaster waiting to unfold. The most significant challenge Paulson faced was convincing others that his contrarian view was not only right, but also the right move to make. Almost everyone in the financial industry, banks, investors, and large institutions were bullish on the housing market. Betting against this market was a dangerous game. People thought he was crazy. Yet, Paulson didn't jump on the bandwagon. He saw the flaws, the fragility of this so-called boom, and understood the risks that others either ignored or misunderstood. As Paulson looked deeper into the mortgage market, he saw something others didn't. The vast majority of the mortgages being given out were risky. These loans were made to people who could barely afford them, and many homes were sold at inflated prices. Paulson recognized that these mortgage-backed securities, created from these high-risk loans, were ticking time bombs. Once the homes started losing value, these securities would collapse. The foundation of the housing market, in Paulson's view, was built on sand. But what could he do about it? Paulson knew that the only way to profit from this looming disaster was to bet against it. And he did so by buying credit default swaps, CDS, a type of financial instrument that acted like insurance on these risky mortgages. Essentially, if the mortgage-backed securities dropped in value, Paulson would profit. Now, this wasn't a gamble. This was strategy, research, and a clear understanding of the market. Paulson teamed up with Michael Burry, another investor who had spotted the same issues. Together, they identified how vulnerable these securities were. Paulson's team dove deep into the details of these mortgage-backed securities, understanding the risks hidden within them. While others were confident in the supposed safety of the market, Paulson wasn't fooled by appearances. He knew the collapse was inevitable. Initially, even Paulson's own investors were skeptical. Betting against the housing market seemed reckless at best, and they were worried that his strategy would backfire. But Paulson didn't just push ahead blindly. He backed up his bet with solid research. He presented data showing how unsustainable the housing market had become. Finally, after convincing his investors, Paulson was able to structure a deal to buy CDSs on these mortgage-backed securities tied to subprime mortgages. He made his move, a move that would go down in history as one of the most successful bets ever made in the world of finance. As 2007 rolled around, the housing market began to crumble, and Paulson's bet started to pay off in ways no one could have predicted. The subprime mortgage crisis set off a chain reaction in the financial markets. Mortgage-backed securities tied to risky loans lost their value, and the CDS Paulson had bought appreciated dramatically. By the end of the crisis, Paulson and company had made an estimated $15 billion in profit. Paulson himself earned nearly $4 billion in 2007 alone. It was an incredible win, but not just for Paulson. The world now knew that a few people had seen the crash coming while others were blinded by optimism. As the banks and financial institutions, like Lehman Brothers and Bear Stearns, faced bankruptcy or were bailed out, Paulson emerged as one of the few investors who not only foresaw the crisis, but also positioned himself to profit from it. He had not just been right, he had made one of the most successful trades in Wall Street history. So what can we learn from this stunning success? First, risk management and contrarian thinking are absolutely crucial in investing. Paulson understood the risks that no one else wanted to see. While the market was filled with optimism, he relied on facts, research, and his own analysis to make a calculated, informed decision. In a world of financial euphoria, Paulson trusted his instincts and the data in front of him. Another important lesson is the power of independent research. While most investors were swept up in the rising tide of the housing market, Paulson took the time to understand the true risks lurking beneath. He didn't let popular sentiment cloud his judgment. By digging deeper and doing his homework, he was able to see what others missed. Finally, contrarian thinking leads to exceptional returns. In investing, the best opportunities often arise from going against the crowd. When everyone else is confident, that's when the risk of being wrong is the greatest. Paulson's willingness to go against the grain, backed by solid research, allowed him to achieve extraordinary financial success. Paulson's story also emphasizes the importance of understanding complex financial products. Many investors stayed away from credit default swaps because they were difficult to understand. Paulson, however, saw the potential of these instruments as a way to hedge against the housing market's inevitable collapse. His success is a testament to the value of financial literacy and the ability to navigate complex markets with confidence. In conclusion, John Paulson's legendary bet during the subprime mortgage crisis is a masterclass in financial strategy. His story teaches us that, in investing, it's not about following the crowd. It's about understanding the fundamentals, managing risks, and staying true to your strategy even when others doubt you. If you're willing to take the time to understand the market and think differently, you can achieve success, even when the world around you is caught up in blind optimism. So, through these two stories, we've learned important lessons about investing and the need for caution when evaluating markets. Every downfall, whether it's Dotcom or John Paulson, reminds us that in the financial world, nothing is certain. Thank you for watching today's video. Don't forget to hit like, subscribe to MindMirror Audiobook, and stay tuned for more intriguing financial stories and lessons. Have a wonderful day, and be sure to share this video with anyone who might find value in these lessons.